Hello and welcome to this week's Mindset. I have Everardo Gomez here. He is the managing director of Hum Capital. I'm excited because we've partnered together here,
Yes,
haven't
we
we?
have. Yes, yes.
So tell us a little bit about, before we get into us and our conversation, but tell us a little bit about Hum Capital and what it is that you do.
So, at its most basic form, we're a funding platform. We help companies find debt. How do we do this? We can plug into a company's accounting system, extract that data, see where that data fits in the world, and then find the most appropriate lenders for that. Um, we're trying to allow private companies that don't have access to the institutional markets, kind of be that bridge.
Mm-hmm.
We do it via data, so we do analytics. We try to show what a company truly is, not just the financial statements that you can give to a bank or another lender. And also, there's a lot. Most of the stuff we do is non-bank, and there's a
Right.
lot of lenders out there, and it's hard for a company, a startup, or a regional company or a local company to get access to all those
Right.
different types of funding. So that's kind of what we do.
It's so it sounds like you're leveraging data to do what's been done and proven successful. You're just doing it a lot more efficiently than anybody else,
Correct.
right? And I think that's what kind of to get into the conversation why we
Uh-huh.
meshed so well when we did initially. I know that you and Udi kind of were the hands that tied the knot together, as we say. So what is some of the tech that well, let me before we get into tech, I'd like to better understand what was the problem that you saw in the financial institution that you felt maybe we could do this a little bit better.
So I didn't found Hum Capital, but I'll tell you overall what one of the big issues are. So especially after the 2008 financial crisis,
Mm-hmm.
right? Regulators eh, installed or enforced a lot of rules that have been there for banks. And so, because banks have you or my depositor money,
Right.
right, and they're insured, they want banks to behave in a certain way. And banks do that and have done that since. And so that has limited what a company can do. If your company loses money, nobody's going to lend you any money, right? And in addition to that, as the internet, for lack of a better term, whether it's software, recurrent revenue, things like that have happened where, hey, it costs you, let's say, $1 to acquire a customer.
Right.
And you're going to harvest 10 cents of that customer every month. And over a year, now you're going to have a profit of 20 cents on that customer. Well, the bank model doesn't fit, right? Because you spend the dollar today to get that over time.
Right.
And so that has to be equity, right? In the eyes of the bank. And so that's where all this other type of financial, but because companies can show through their data that repetitive, hey, this customer is going to stay with me. Hey, if I invest X amount, I harvest or I collect this much later, right? There's mechanisms being built to allow for that, to use that instead of just 100% equity, to use debt for that. And that's, more efficient for a company.
Yeah, especially a company like ours, where and I know that's what got us so excited about what you're doing. Is one, we're big on leveraging technology, and so is Hum, and we'll get into that a little bit. But what was it about kind of your perfect, I guess, your perfect institution that would be a good fit for someone like Hum? What are you looking for?
So honestly, we can do everything. So um, we have companies that are, I would say, banking. So we have companies that are hundreds of millions of dollars in revenue and are very profitable, but the CFO doesn't want to run a debt process. And those companies can have 10, 15, 20 lenders trying to do something for them. And we help them find the best one. And we help them prepare their information so that those banks can ingest it easily. Sometimes, it depends who your CFO is.
Okay.
It depends if you have a CFO.
Right,
It
right,
depends their experiences, their background, and how many other things they're doing at that one point in time, and can they dedicate, this time to running a process, right? Sometimes it's just relationships. Like, hey, um, you know, they'll ask another CFO, hey, who do you bank with? Or who gave you your loan? And they go, oh, so and so. Okay, well, can you introduce me to so and so?
Uh-huh.
And that's it, right? It's not a very
Difficult
sophisticated
process,
process, right? But if they do want to run a process, there's investment bankers, and we do a similar work for that they do, and we can do that also. So again, I would say, for a company to find debt that's interesting and probably worth their while, they have to have 2 to 3 million in revenue.
Okay.
Just because if you're smaller than that, then you need to have like VC backing and significant VC backing
that
to
time,
get lenders excited.
Even diluted and yeah.
And so I would say that's the minimum, and as big as it doesn't matter. Like,
Okay. So is there, do you look for someone in a specific industry?
so we don't, but I would say the market today, and we don't, we don't make the market. Anything that's recurring, whether it's software or, you have data and evidence that, hey, if you invest X amount of dollars today, you're going to get Y amount later on. That's exciting. And that there's there's a lot of lenders willing to be aggressive around that. And the market too. Even with the current, down market, still, if you look at a SaaS company, the multiples are still very high. Why? Because people are starting to believe that those stream of cash flows are real and will come. And that's today, I would say, the most aggressive market.
Okay.
But you have e-commerce companies.
Right.
You have other transactional companies. You have companies that live in for example, the Salesforce ecosystem. And, anything where there's data that shows that a dollar invested today, is going to be more in the future, then those we can help. Because if you look at a traditional P&L, right, of a company, you only see revenue, right? And again, if you acquire a customer who's going to be with you for 3 years, you can only book the revenue of
for so long,
right now, right? And so you don't get the benefit of that. That's probably the biggest challenge we're solving today is kind of bringing that future information until today.
And I think that's super important because most people don't actually leverage that information. Your standard financial institution doesn't necessarily, I'm sure they have their long-term plan. They look at, growth over month or year over year, but they don't take that framework and say, well, if a dollar is coming in today, how much of that dollar can I use to kind of leverage, my resources to grow? And what worked so well with us was we are at this period of growth, and we had that consistent revenue coming in. And we didn't want a VC. We didn't want someone who's going to come in and take over and dilute, the amount of work. Because you know how this goes. As a startup yourselves, you're pouring your blood and soul and your heart and your tears. Everything you do is for your company. And it really takes a little bit of a kind of a small poke to the heart when someone comes in and says, I'm owning you and I'm taking over. So
yeah, 100%. And there's companies for everything and styles for everything. In the VC model up until today, right, it's about home runs. And so there is an additional risk involved in, their model is for you to grow as fast as you can.
Right.
And that's not easy. There are very few companies that can achieve that, right? You have your Facebooks, your Googles,
your Amazons, and
Amazon.
Yeah, exactly.
And even, some of those were not as exciting for VCs early on, right?
Well, you go through, as a startup, you have most VCs who expect a certain limit before, a cap before they even talk to you.
Yeah, and once that capital is here, it needs to be deployed, and you need to grow very, very, very fast, and it's hard. And so there's, there could be a twin company of SetSchedule, right? But their team wants to grow as fast as humanly possible. And they're only focused on a home run or nothing. Right. And that's a fair strategy. Yep. And there's people for that, and people. But debt is more for, hey, I may not want to grow that fast, but I also don't want to risk, putting all my eggs in that basket of super hyper growth. And so there's for everybody. And those type of companies don't get the headlines as much, right? And so people are not.
They're
talking
not as
about
familiar,
them,
aware,
but there's a lot of great businesses that can live outside of VC.
Fair enough. So just to be clear, Hum helps businesses such as like what we did with SetSchedule, and you actually help find investors and those who'd be willing and have a desire to invest in SetSchedule.
Correct, and I do debt. So Hum Capital does equity also, but I personally only do debt.
So what is it about debt that kind of got you excited or intrigued in that versus doing capital?
So okay, so I've been in debt my whole career. I started a long time ago. I used to be an engineer.
Okay.
I worked for Lockheed Martin on fighter jets.
Oh, wow.
So that was the kind of engineer I was. And I went to grad school and moved over to banking. But so I was doing the credit side. I've never been in the
On
equity
one
side.
side engineer,
Yeah,
the
I
other
know.
side banking.
But
It's how it tends to go nowadays.
yeah, and so I've always been on the debt side. And one of the things that I've always been very curious, and this role allows me to learn about a bunch of different companies all the time. And that's exciting. On the equity side, what we do, and I'll let them, if you ever want to have one of the equity folks come here, is we try to help companies that are bigger because the more data they have, the more we can help. At the very early stage, when you don't even have revenue, it's a lot of relationship based, right? It's, hey, the team and this and that, and we're in the data arena, right? So it's not a great fit. Not that doesn't mean that they can't do it or anything like that, but so we have to have data to be very helpful. And so, but why debt? That's what I've always done. I've always found kind of the regulator rules, because I was always in banking, to be restrictive, and they're always backwards looking, right? So like every metric that you could ever think of that a regulator is going to look, it's backwards, right? And so this, especially with recurring revenue and SaaS and all that, this revenue models that are different. The exciting part is what's to come, not what's already happened most of the time.
And
you can't see that in a traditional financial statement.
I like that. That's a very I guess new way of looking at this whole financial institute. So ICM in short is your intelligence capital market.
Yes.
Right. That's basically a platform that you have introduced. Tell me a little bit about that, because I've done some research and I still can't fully grasp, which I guess is kind of the point. But yeah, how does that work?
So a company can join on the platform. It could be self-service, right? You can go in, log in, get your login information, put all the information about your company, plug in your QuickBooks or another accounting system, and that signals us, hey, so you indicate, hey, I want to raise 3 million, 6 million, 1 million, half a million, whatever the number it is, right? And in this time frame, and that triggers us to say, hey, depending on the data, we get I would say a roster or a schedule of lenders that could be a good fit for those numbers that were there. Today, I review that, or somebody like me reviews that and says, hey, does this make sense? We look at the company. Sometimes we talk to the company ahead of time saying, hey, kind of the use of funds. What are you going to use them for? Or, hey, I see that this one variable, it's going to be tricky or a problem. And some of the times it's liquidity, right? Lenders don't want to provide money when you have like $5,000 in the bank. Right? Like even the most aggressive lenders want something there, right?
Right.
And so if there's anything like that, I talk to the company, and some of the times the company is like, yes, I know, one of the founders just injected capital, but you can't see it in my QuickBooks yet, or he's going to do this, and we want the debt to come alongside of that. And so there's a little bit still of that, hey, what are you going to use? And sometimes, the companies or the people in the companies, they don't know what they can get. And so that's, sometimes they say, hey, but what's out there, right? Like, hey, there's revenue-backed finance, there's term loans, there is asset-based lending, there are factoring, there are a lot of different things, and sometimes it's a conversation. And after that, we have the roster. Now we have their preferences, a little bit maybe subjective preferences, and we start making introductions.
Right.
Now, on the lender side, right? The lenders have provided us with what they want. And so we're only going to connect to companies, or a company and a lender, that the lenders already agreed to look at a company like that, and they're willing to do something for them, or unless they find something that they don't like down the road, but they already saw an anonymous version of that company and say, okay, I like the business, I like the size, I like what they're asking for, I like this other, technical things, let's connect. And then we connect them. And if for whatever reason there's something on the company that the lenders that were highlighted are not, there could be hey, I'm busy right now. Hey, or no, I changed, I used to like software companies, now I like e-commerce companies. And then that introduction doesn't happen. There's very few times that there's companies that their expectations of, hey, okay, I can get some of that. But if I don't get, for example, a company that wants $3 million, but the market's saying you can get 1 to 1.5. Sometimes they say, you know what, that's not interesting enough for me today.
I see.
I'm going to, use the
revisit the
capital from one of the
conversation.
founders, or I'm going to do something else because that doesn't solve my problem.
Right.
And so there is some of that where it's not enough for what their expectations. And we're always working as quickly as we can or ahead of the curve on expectations. But sometimes there's just things that the market says, we can't do that, or they're not willing to do that, or the price to pay to get to that point is too expensive. Because people are used to bank rates, and when you're outside of a bank, it's not a bank rate.
It's not your typical, standard deviation of yeah, I understand variables. But, I mean, so you leverage tech a lot. I mean, and what was really, I guess, exciting and fun for us, and again, we like to focus on what's important for us as executives. It's the business, right? We don't want to necessarily have to sit there and have that conversation of here's how much we have and here's assets and here's money coming and going, and you do all that data yourself. What got us so excited was the fact that we didn't have to sit there and look at the QuickBooks. We just made it available to you. You accessed it, and all that tech seems to have run it. How did you come up with this kind of mindset?
So that was before I joined.
Okay.
Really, that decision to do that, and they've been working on. I say they, but the company's been working at generating those analytics and those insights before I ever got there. And so, where the genesis came from, our founder used to be a venture capitalist. And I think, and one of the things that he's mentioned is that he saw how the process was a little broken on fundraising, any fundraising, where, hey, it was more relationship based than data driven. And so that's been his main focus, is to make it data driven. And that's, how do you do that? Well, let's make it easy for the company, right? Let's plug into your QuickBooks or any other accounting system. All right, well, we generate your P&L. Okay, well, that's good. It's good first step, right? But that doesn't tell a lender anything else.
Right.
So we can do cohort analysis. We can do, comps.
I'm not familiar with that.
So cohort analysis. Okay, all of your customers that joined in January of 2018, what was kind of the revenue that you generated from them?
Okay.
And so you get to see these curves on hey, and there's some businesses, right, that it starts really slow, and then all of a sudden, boom. Right. But there's some business, and there's one business that I'm thinking in particular, I cannot say the name, but it takes them a good 9 months. So they go and they sell a product to a company.
And 9 months
but
later,
9 months,
wow.
because they see where
That's a long
other
sales
people
cycle.
start adopting the seats, right? And so, but you get to see that. And so as they start getting into more and more companies, you start seeing that. Well, that's not in a financial statement, right? But we can generate that data.
So how many, and this is not necessarily the question that we have to talk about on our paper here, but how many teams do you sit with when you put these graphs together, you put all this data together and you show it to them and they go, wow, I've never seen my business in this kind of format?
There has been some. I mean, there's somebody that used very colorful language when and it was like, oh, this, colorful language exists, and that was pretty cool, I have to say. But yes, now, a lot of them have that information in their KPIs, right? They're
tracking, they're measuring it, they know what it looks like,
it's
it sounds
there.
like, right.
They just don't see it all put together and
Yeah.
why it's important sometimes, or why a lender would care. Because historically, all they care is looking back, right?
Right.
And so,
going back to that, yeah.
And again, and it could be that that some of those charts don't look so pretty, right? And something's, the company, the team is like, I'm spending a lot of money to not get a lot of bang for my buck, at least on this, right? Or, hey, they can see, oh, yes, I remember those 3 months we ran some, or 6 months we ran some ads that were super expensive. And yes,
We
that
made
was
a-
not very
yeah.
productive.
Right.
So, yeah.
So I'm a first time, business owner. I'm,
Mm-hmm.
doing fairly well. I'm now thinking about, raising some money so I can take
Mm-hmm.
things to, first rounds. What information does someone want to come to you with that you can turn around and say, this is someone we can help versus maybe your standard VC or
Mm-hmm.
bank, lending makes more sense?
Yeah. And again, we can help them with banks too. Like
Okay.
we have
So
relationships
you
with
have
banks.
the ability to help
Oh
them?
yeah.
Oh,
Yeah, yeah. It's
interesting. I
just
didn't know that.
normally if they already have a bank,
They don't
they're
need you.
probably gonna have a good enough deal, right?
Fair
But there's people that are like, hey, I like my bank, but I want to see what's out there. And in our model, we didn't charge for that.
Mm-hmm.
And so, we're like, hey, we'll run this for you. And, because of technology, it's not so expensive for us.
Right, right.
And so we'll run it. And, sometimes they're like, you know what? My bank is actually really good. And I had a really good deal. Now, sometimes when I talk to them and I see that it's a bank profile and they already have a bank, I tell them, hey, what's the issue? Like, do you have an issue with your current
Why are
bank
you
or
coming
not?
to us in the first
And
place?
sometimes
Yeah.
like, no, I'm just shopping. I'm like, okay. And I can tell them like, yeah, the deal you have is it's a smoking deal. Don't worry about it. Or yeah, there's probably going to be, somebody that's better. And there's some things that we can't predict. There could be a bank that just hits it off with them. And they've had a couple of companies that look just like that one, be super successful.
Mm-hmm.
And they're going to be all in. And there's some that like, oh my God, they just got burned by a similar company. And
We're
they're going to
out.
be,
We're out.
And
Keep
so
us out of this one.
there's chance. But, again, if a company wants to raise some debt,
Mm-hmm.
what are they going to use that debt for? Is it to buy out an existing shareholder? Is it because they need more working capital? Is it because they're going to hire more salespeople, more developers? Like, what is that going to be used for? That's key because that's going to drive us to a certain amount of lenders, and we can set expectations, right? Like if your company is doing X revenue, but you want to buy out your partner at Y, well, there's going to be nobody there for that. But we can at least set some expectations. They can connect to the platform directly. They can send us their CSV files with all the information, and we can upload that. That's really it. They come with an open mind, and it depends. Do they want to talk to a lot of people? I can facilitate a lot of
Right.
introductions, or they want us to say, hey, you talk to them, you give me the best couple, and then I'll talk to them. We can do that too. It
just all
really
matters on
depends.
the relationship over
Yeah.
there, yeah.
And at the end of the day, is companies can go through this whole thing and then realize that they really don't want debt. That because there will be usually covenants. There will be additional reporting that you need to do every month. There's going to be certain things that once they see that, they're like, you know what? It's not as important to me. And that's perfectly fine. At the end of the day, it's, hopefully the owners, the entrepreneurs, the companies get funding to grow, get funding to do something better and for their success.
Fair enough. I mean, and seems like a very fair concept. If you're going to be providing someone with some kind of investor, you're going to need to open up a little bit more than
Yes.
you normally would. How does Hum kind of find the investors that you might introduce?
So some of them come to us. They see press and articles, but we have, I brought my network. Our founder brought his network, and we haven't really talked on the value for the lender, but the lender, instead of having to go chase for companies, we can send them directly to them.
Right.
And not only do we send them to them, we send to them a profile that they know is
They've
going to
already
fit.
got a nice, manila envelope with all the data and
Well,
everything they're going to be looking
it's
for.
usually it's supposed to fit what they want, because
That-
we've
that's-
talked to them in the past. They told us their parameters, their criteria.
So you're tailor fitting for both sides. You're
Exactly.
tailor fitting for the
Yeah.
company and you're tailor fitting for the investor, which makes it seem like just a perfect kind of, equation for a successful partnership.
Yeah.
So,
So that's the idea. Is and the more we iterate, the more we learn, the more deals we process, the better we get at sending very specific things to very specific.
and we're
lenders.
here because we came to you and said we're looking for an
Yeah.
investor, and you perfectly set CapChase with us. And actually, we had CapChase here And Miguel's here. Last week, he and I did
Oh,
a
nice.
mindset, and that worked out really nicely. And then we also have I know we recently, all three came together to publish a blog that you put together and published on your site. So, out of curiosity, I mean, for me, because this is my first time engaging with you, what was it that about SetSchedule that got you guys excited about us coming to you and saying, hey, we want to partner and find an investor?
So, part of it is being able to using technology, right? But being able to keep a customer, right?
The
Being able
retention.
the retention, and the ability to, I would say, upsell, cross sell, provide more value to the same customer over and over again. That's important and that's valuable. And again, that's one of the things where historical financials don't show that.
Right.
And so anytime you have a software that's sold, as a service where there's a monthly payment, it's really powerful because again, you can measure that retention, you can measure that churn, and have a pretty good expectation of what's going to happen in the future. And so that helps everybody foresee the future. Now, things can happen, pandemics and things like that, but at the end of the day, especially businesses that have withstood or thrive under those conditions, right? Then it gives you even more comfort than the team, the business, the value provided will withstand the test of time.
What is a perfect client look like for Hum? I
So,
know
I mean,
it might be a little bit of a
Yeah.
difficult question to answer because, quite frankly, from the more we talk, the more I realize you could pretty much work with just about anybody.
Yeah.
It's not like there's a one size fits all, and if anything, one size all fit Hum, right?
Exactly.
Um,
So, I mean, I wouldn't call that perfect, but if a company already has talked to, I don't know, 15, 20 lenders, then we probably won't want that much more value. But if a company has a limited network and they want to access, the overall United States, credit market, that we can really help. Perfect companies, one that's ready for debt. What does that mean? They can
That's
generate,
good.
they can generate reports.
right.
They can predict. They can have good forecasts, right? They can say, hey, with that money, I can do this. Also could be a long working capital cycle. So somebody that, it's physical goods or something like that, but it takes them a long time to collect, or they have to send money ahead of time to then produce something, to then sell it, and
So
then
you
collect.
can front load the money to them. They can sustain
Yeah.
it, and you know that the money's going to be
Yeah.
coming in again. Like the
And-
example was
yeah.
9 months from now. right?
And that's not a new market.
Right.
So that's a market that's been around for a long time. It's just that we have access to a very large network.
One thing I haven't asked you, Everardo, is what is debt financing? It's something that not all, business owners are familiar with, right? It's not your standard investment kind of framework.
Correct. So debt, there's different types of debt. Now, most debt is, hey, I borrow $1, I'm going to pay back $1 and something, right? There are debt that it's interest only, so you pay interest only for a period of time, and at the end of that, you need to repay all back. There's debt that is, you sell, they don't call it debt, it is debt, but you sell your future cash flows, and you sell them today, and so you sell them at a discount.
So
or
I'm selling it to you now, and
Yeah.
in the long term, you're going to.
So I have customer A. Let's say I'm going to sell customer A's revenue, just to make the example
Okay.
easy. And that customer is going to pay me, $100 a month for the next 12 months.
Okay.
So that's what, $1,200? I will give you 800, 900, some amount of that today. And I will collect over the next 12 months that amount. Now, it could be that I give you the 1,200 today, or I give you 900, and then you pay me more, whatever combination it's. But I call that debt also. Now you have, hey, if a company has assets, so if a company has accounts receivable, inventory, right? Those assets could be levered, and that's asset-based financing. If you have a receivable from Target, somebody will give you 80% of that today, and when that comes in, they'll keep 5% or something like that. or 2% or 1%, depending on the time. That's debt. Is, somebody gives you money today and they expect it back. An investment, equity investment is, hey, I give you something and now I own a piece of your company, right? So that's kind of the very rudimentary definition.
What when someone is starting to get into thinking about rounds of funding, what is an advice that you can give someone for them to know maybe it's the right time to get into with investors? Because I think that's the question that a lot of entrepreneurs or businesses like, I'm doing well, or at least I feel like I'm doing well, and I know that if I had X amount of dollars more, I might be able to. But when do I know that it's the right fit for me to start to come to Hum and say, hey, let's think about it?
Yeah. So I'll start with the easiest one, is when you have a bunch of assets, right? So you have a bunch of accounts receivable, you have a bunch of inventory, right? You're saying, hey, I have all this assets parked here. Let me help it move it along faster. That's one. That's fairly easy. People know about that. But the other one is, do you know the repeatability of your business, right? Like, do you know your metrics? Do you know that if you invest $1, you're going to get $1 plus back? If you know those things, right, and you have data around that, then you can use debt to accelerate that growth. Now, our platform is not very useful. It could help, but hey, you want to take some money out of the business to go start something else. That's a different type of lenders. And again, it could be perfectly fine, and we can help with that too. That's not what we see day to day. Day to day, what we see is companies that want to grow faster and they want to use debt. Also, there's a good point, right? Like, hey, you get to a point where now you've hired a team that helps you run the company. And so now you can scale. Because, if you're at the breaking point today and then you add fuel to the fire and you haven't hired, right, or don't have that
to burn.
The team,
right?
Yes, you're not going to be able to fulfill that growth, right. By yourself.
Right. How was 2021 for Hum? I mean,
it was really good.
Really?
It was a really good year. The credit markets are very active. Bigger players are going after smaller players. Smaller players are going after bigger
it
players.
Seems like a total chaotic market right now.
On the equity side, yes.
Yes. It seems.
But companies that have fundamentals for debt, it does trickle down, but it trickles down more on the companies that you will be providing debt based on the next equity raise.
Okay.
So companies that are burning a lot of cash, they have a harder time in a credit market like this. Last year, they didn't. Last year, it didn't matter how much you were burning. There probably was somebody for you. Today, if you're burning a lot, and so you would need to raise equity in the next 6 to 9 months, the credit folks are a little bit less aggressive or more hesitant to do that deal. That doesn't mean that they're not doing it.
Right.
But for the right company, they will. But that would be the one change from last year is more evaluation of the companies or a tighter evaluation on companies that are high burn.
Why do you think it's changed so much? We're still seems like the same. If anything, it seems like there's more cash out there now with what's going on. Why has there been such a change from last year to this year?
So I think
the year prior, really.
So yeah. So government signaling of the ending of QE, right, or those things. So when the equity markets, the public equity markets, get hit, right, that kind of trickles down to VCs. So VCs need LPs, and LPs, right, the limited partners that put the money into the VCs, right, the money behind the VC, they probably are large pension funds, and they play in the large public equity markets. And when that goes down, then they say, hey, and so that. But again, also, if a company, was 100x revenue, their valuation in the public markets, and now it's 50, still great. I mean, it's still awesome valuation, right, for all historical sense. But now it's 50. So now that VC can no longer, they're just invested at 100 times. Then that investment is not a positive, it's a negative investment. So they may pause. And so if a company requires equity between the next 3, 6, 9 months, those companies may have a harder time raising equity. Maybe not. But that's why credit folks will just take a look at that specific company saying, okay, if before I was okay with 6 months of runway, now maybe I do 9 or 12 because I want the company to be able to,
Sustain
if there's any
that
lull in the
right.
markets right now or any more turbulence that we don't know, sustain that, right?
Right.
So again, that doesn't mean companies cannot,
Still
reduce
fine.
burn, right?
Right,
But
right.
that's the one I would say sector that's a little bit. You had last year, added due diligence on supply chain stuff, right? So with COVID and all that, things were taking longer, but most companies solved that. Most companies just added a couple of weeks to their supply chain, and that was it. The Port of Long Beach, all those containers. So it wasn't major. There hasn't been any major disruption like there was in 08, 09. Nothing like that.
Interesting. It's such a there's so many variables involved in this market that you don't, unless you actually, yes, you're in it yourself, you don't necessarily spend the time to think, well, how is this going to affect me? How is it going to affect my business? And it's really insightful to see how much a company such as Hum is able to take, the needs of like a business and really provide them, because it sounds like you do so much more than just, hey, let's find you an investor. That seems so simple, but
so yes, I mean technology, and I guess I'm talking about all the things that the technology does, right? Help us kind of, but there's still, a little bit of a human element today on I would say companies are not used to. Maybe large companies are, or very professional CFOs. Like, okay, this is exactly what I want, right? Like, I need exactly
so
this
how
and
important
this and
is
that, right?
How important is
So-
for a business, a small business, to say this? I know this is exactly what I want, and I'm gonna go after it, and I'm gonna try not to pivot because we know we have
Yeah.
to, but I'm gonna try not to pivot as much as I can.
Yeah, so it's not so important. That's why I ask, right? And it's a little exploration because they probably haven't explored it as much.
Okay.
And I'm like, okay, so what is this money for? Well, I'm gonna add 10 salespeople. I'm like, all right, over what period of time? Well, as soon as I get the money, I'm like, oh really? You're gonna hire 10 salespeople?
They're ready to go now.
They're ready
Right
to go,
now.
right? Well, no, it's probably gonna. Okay, then you don't need X amount today. You need it over the next 3 months.
I see how
over
you-
the
okay.
next 6 months, right? Or hey, I'm gonna hire 20 developers. I'm like, really?
So what are some questions that I can ask as a small business owner, or even a medium-sized business owner, I can ask these questions to myself to really put a strategy in play? Because it doesn't seem like someone who just says, I need the money, I want the money, I'm ready to go, is someone that we want to, I mean, that doesn't sound like the right play.
Yeah.
It sounds like you have to have you have to have a plan in place, a strategy in place to know where what you're spending the money on, how you're spending it, what's the period of time. What are some questions that someone can ask themselves that might help them kind of clear up that vision for themselves?
Yeah. So I mean, it could be companies that are doing online marketing, for example.
Okay.
Right? They're like, hey, I just buy more more ads. Well, that's a very simple one, and yes, they can toggle that, but it gets more expensive, right, as they spend more, theoretically. So okay, and he goes, well, I need $3 million for that, and I'm like, okay, are you going to spend $3 million now and start harvesting? Are you going to do it over time? Why? Because I want it to be more efficient for the company, right? The company's going to start paying as soon as they get the money, right?
Right.
And so, hey, if you can, do that over a period of time, that's
You're not paying as much as early on, and that
But
actually
but
it's a
also
win-win.
it reduces risk because if you say you're going to spend $3 million, but you spend your first 500,000, and you see that prices went through the roof, you're like, oh, I
I'm
need to
not gonna
stop.
spend, right?
But
Now
what are you
you're
going to do with
$2.5
it?
million that you're paying interest or you owe someone money on, right?
Exactly.
Right.
So that thought process, okay, how am I going to spend it and when, is key. A lot of them have not thought about the when.
Mm-hmm.
They have, okay, I need to buy this, I need to do this, I need to hire X, I need to hire Y. Okay, in this, labor market, right?
Right.
How long is it going to take you?
Right.
And for example, like a simple one is, hey, I need to expand my office.
Okay.
That's what I need. So I need X for the rent and X for that's valid. Yes, you can find that or something like that. Like, hey, I need to buy more licenses for my developers. Okay, that's a very specific thing. I need to buy equipment to build a new assembly line or production line. Okay, those are very finite things. But all the other ones, the hiring, sales and marketing, developers, etc. I work with them a little bit to understand exactly and how fast they can do that, because it's not as easy as just putting an ad on the paper, right?
Yeah, and again, you don't think about the when on a lot of the times, and it's just when it comes to you're so focused on your business and that you really do need someone from the outside who has that experience, who knows to help out sometimes. So I love that. I think that it seems like Hum is really not just for yes for the financial aspect, but do you have, let's say, a questionnaire maybe that someone can ask themselves? If I go and I create an account on the ICM, are these questions listed somewhere that might
yes,
help me?
so they
kind of-
are. I guess maybe we can expand on it.
So
We do kind of timeline.
Okay.
We have amount,
Uh-huh.
right? So that gives us a kind of a rough estimate.
So it kind of forces me to maybe have to
Uh-huh.
answer those questions that I haven't
Yes.
asked myself. Because so on our platform, we're really now, with the new 3.0 application that we created, it now allows solopreneurs, entrepreneurs, small business to really start to kind of expand their network and find ways that they can communicate and maybe ask questions for people. And we do see a lot of those, financial help questions where someone goes, well, in this market, a year ago, I used to be able to hire someone at X amount of dollars, and now I'm being told it's X times, or X plus whatever. And am I set up for, success with that kind of financial structure that I have now? And a lot of a lot of small businesses don't know. They don't have somewhere to go to maybe ask those questions, and that's kind of why I asked that. I think
Yeah.
that would be very useful for those who are kind of start thinking about, well, what happens now? I survived the pandemic. I'm now in a position where I'm ready to kind of grow with the market again. I'm ready to grow with what's out in ecosystem, right? With around my ecosystem, and how do I do it?
Yeah. It's key, and we balance a little bit on the, how much information to ask of somebody
Fair
right
enough.
before,
Okay.
they know us
Uh-huh.
well. And so we struggle with that a little bit, because the more information I have the first time I look at something, the quicker and better, our recommendation is going to be. But we also make it, we understand that it's usually a very big step for the entrepreneur, for the business owner, or the CFO, right? That, hey, they're going to make a big decision, and we still want to be there for them. Now, again, there are cases, and there's more and more of them, that they know what they want, and their experience, and they're like, okay, this is what I want, and we send it off in its merry way fairly easily. There's some that are not. There's more story to be told, but yeah, we're here for the journey. We're here to try and help in that success.
That's awesome. What's going to be happening in 2022 for Hum?
Wow, a lot of growth. We announced, I think we announced our equity vertical, and that's super exciting. But continued adaptability, right? At the beginning of last year, things were getting exciting again. We're opening up again, and then we didn't.
Right.
And so I think this year there's going to be, volatility. There's been already volatility in the markets, but good companies. There's always a market for good companies, and we're going to continue to help the entrepreneur tell the story, or the business owner, the CFO, or the VP of finance, or the accountant that is now tasked to, hey, find me debt. Right? We can help. You don't have to be a pro. We can help with that part, and so continue to help companies, continue to refine our process. There's some interesting product things on the roadmap to make that even more efficient, for less work for the company. But that's still TBD on when those will be. But ideally, one day, there won't be a need for me, right? All transactions.
You could go off in your
all transactions will be
beach
automatic.
house front, yeah.
But there's also, on the lender side, they still do things their way, and they want information their way. And it doesn't matter how much information you provide them, they still need it their way. So there's still some, I would say, comfort to be gained, or some trust on that side to say, hey, okay, the data is presented this way. I can make a decision with that. I don't have to go and slice and dice it again. So there's some of that.
Awesome. So we're coming closer to the end for our time. So I always like to ask this question for, again, our platform. We have a lot of new businesses. What's some advice that you can give someone who's maybe getting ready to start thinking about, okay, is it time for me to start finding an investor for me to grow? what's maybe a quick words that you can give someone to kind of help them really understand what they need to do next?
So that's a very good question. I would say when they know, well, okay, if you're trying to raise VC and you're in a very highly technical role, and your company either doesn't have revenue or doesn't have customers or things like that, then it's all network, and you better start networking. Whether you went to Stanford or have a friend that's in VC or something. But let's take that aside, right?
Okay.
And so, hey, you have some customers, right? How fast are you growing that? Are your customers coming back? And once you have some patterns of customers coming back, customers enjoying your product, customers buying your product, then you can go out and find investors, whether it's the debt or equity. That's morely equity. So debt investors start playing where they know when they know you can return their money, right? And so if you want to keep growing super fast for now, equity is a great vehicle. If you already have product market fit, you already have sufficient, more than $1 million in revenue, more than $2 million in revenue, then you can start looking into debt. But before that, it's really equity that gets you there, because there's a lot of work that goes into providing debt to a growing company, and the lenders want a bang for their buck, and so they want slightly bigger numbers.
Fair enough. That's sound advice. By the way, what's your passion? What is it that gets Everardo up in the morning and gets him excited?
It's really kind of learning. I'm very curious.
Yeah.
And I really enjoy learning about all these companies that do different things. So that's why it never bothers me to talk to the entrepreneur, and one day it won't be needed, but I enjoy it. I know it's kind of like, but it's really cool to see people succeed and companies have success. And whether I have no part of it, right? But because but by the time they talk to me, they've had success, right? And so it's really cool to at least to know all that.
You just give them the catalyst to explode even further.
Even if that, they've gotten there without anybody's help, right? Or without our help. And so learning about those companies, really, it's the thing that gets me the most excited. So
that's awesome.
Weird. Yeah.
That's awesome. Sounds like you're in the perfect position
I get to see a lot.
to be doing that then. Awesome. Well, Everardo, thank you so much for joining us. I really enjoyed this conversation. I learned so much from you, and I look forward to continuing our partnership and seeing how things progress with both of us in the 2022.
Awesome. Thank you very much.
Thank you. Take care. We'll see you guys on the next one.
Bye.